Well, hey there. It's Thursday, so you know what that means? It's 3 Minute Thursday. I'm Terry Sawchuk with Sawchuk Wealth, and today I want to talk about CPI, Consumer Price Index, and it's the way the government measures price increases for things that you and I are going to consume on a daily basis from one year to the next. So interestingly enough, on this past Tuesday, the government reported the monthly CPI number at 3%. Now, expectations were it was going to be somewhere between 3.2 and 3.4%. So when it came in at 3%, when the market opened, the stock market on Tuesday, it took off. And it just kept going up and up and up, and even into Wednesday, up and up and up. And so I think what really happened, now some people think that that was because the Fed's likely to not raise interest rates anymore because their target is 2%, and since inflation from the previous month had slowed down a little bit, that inflation is dead. I don't think that's true at all. In fact, if anything, this is a temporary pause. And while I don't think it's going to go skyrocketing from here, I do think that year-over-year comparisons are going to get a little bit more difficult. And so it could creep up a little bit for the next couple of months, which would fly in the face of all that logic. What I think happened with the stock market is entirely different. So I'll get to the other part of CPI in a second. But as far as the stock market is concerned, I think a lot of fund managers, hedge funds, and other institutional players came in short. They were actually betting that the stock market was going to go down because they thought the CPI number might be a little hot. Well, when it came in way below what everyone thought it was going to come in at, the stock market took off, and that meant that everybody was short immediately began losing money. And so the deeper the losses got, the more they had to cover the short positions, which means when you cover a short position, you actually have to buy the stock or the index that you're shorting, which just pushed prices even higher. So it became this snowball rolling downhill where it just kept gathering mass. Now, I think that's probably run its course. And I think the more likely scenario is we're kind of at the tail end of this bump up in the stock market. It's running out of gas, and likely we're getting really close to at least a short-term top here. What's interesting about the CPI report, though, is that there was one line item. It was health insurance. And the government reported a 34% drop in health insurance costs or premium costs, which is obviously not the case. It was a change in the way that they report the numbers, which led to this big drop in the number. So the CPI number wasn't even right. Actually, prices had been going up, and I think Wall Street is smart enough to figure that out. So I think the rally was more a short covering rally. And if you look at the bond market, interest rates have crept down, and that's the bond market telling us they think we're heading to a recession and that next year deflation is going to be the bigger problem than inflation. So I hope that helps clear up the CPI mess. I look forward to seeing you guys next week on Thursday for 3 Minute Thursdays with Terry and apparently Jim too.